Okay, so this is the first topic we want to learn under risk and insurance management. Okay, the problem of risk. At this time, we want to understand risk. How risk is different from peril and hazard. We want to know the classification of the types of risk that we have. Okay, we want to understand what needs to be present when you are defining risk. Okay, so today we want to understand risk. Okay, now the fact that there is a possibility of you losing something is what we call risk. Now, we want to say that risk, we are surrounded by risk. We are surrounded by risk. Risk can happen anytime, anywhere. So you might be having something in your house. It can be stolen. There is a possibility of it being stolen. The degree of possibility might be low, but there is a possibility of you losing the car that you are owning, right? There's a possibility of you deviating from what the objective is set for a period. For instance, if you want to become a doctor, right, a medical doctor, and you end up becoming a nurse, you have deviated, right? So the difference between you becoming a doctor and you become a nurse is what you have done. Okay, so wherever we are, wherever we find themselves, there's always likelihood of you losing something, and that is what we call risk. So we say here that risk is inescapable condition of human existence. Is what? Inescapable condition of human existence. The concept of risk. Now, I want to know that when you are defining risk, two things might be present. That is indeterminacy and loss. Indeterminacy and loss. When we talk of indeterminacy, what are we talking about? There should be a notion of an unknown outcome, meaning that if you are certain that you are going to lose a particular thing, then there's nothing like risk again. If you are certain that you're going to lose a particular thing, then there is nothing like risk. It should be unknown. It might happen, it might not happen. That should be the case. Then we call it risk. The moment certainty comes in, then we are not talking about risk again. Okay, all right. The next thing is loss. Loss. There should be a possibility of loss. There should be a possibility of undesirable outcome. There should be a possibility of you deviating from what you set to achieve, where you want to reach, what you owe. There should be a possibility of loss. Okay, so these two things must be present whenever you want to explain the concept of risk. Indeterminacy and loss. Okay, now let's move forward to risk. Now risk is the possibility of you losing something, or the possibility of you deviating from a set objective, deviating from the desirable outcome. This one is the condition of the real world in which there is exposure to adversities. There's a condition of the real world in which there is exposure to adversity. Now, why are we talking of the real world, right? Why are we talking of the real world? Real world because what happened? It happened in what will cause the loss? It's a combination of circumstances in your external environment. In your environment, where you are staying, where you are working, where you pass to your house. So your environment, circumstance, a combination of circumstance in that environment will determine whether is what expose you to the possibility of loss, the possibility of you not meeting the desired outcome, right? For instance, if you are a brilliant student and everyone know this student is going to perform well in his test or exams, then apparently this person lose his mother or father. The psychological trauma can affect a person's performance. Or if there is someone, a student who is very brilliant, but then he comes from a poor family where they cannot finance his or a schooling. The person is likely not to school to the highest level he or she is supposed to up to. So the circumstance in the person's environment has affected the person. There are instances where a house has got burned because it was closer to a gas station, right? So the environment, where it is what affected the loss of the house. Okay, all right. Then the possibility of loss, which I've already explained. Okay. Now we say that for risk there should be what? There shouldn't be any certainty, uncertainty. That was the indeterminacy. So there should be doubt. There should be. I've talked about this thing. So there should be. It will happen or it might not happen. There should be. There should be maybe one possibility of you losing the thing. You get me? Then we call that there should be what? Uncertainty whenever we are talking about what risk. Now we come to the degree of risk. The degree of risk. Now that's where we want to say the probability of you incurring that loss. We are looking at the probability of the person. Okay, this way they are using the likelihood of I'm coming. Okay, the likelihood of occurrence, right? The possibility that the risk will occur, right? So why do we term some investments? Why do we term some things more riskier than the other, right? For instance, if you are going to buy treasury bill, and if you are going to bet, which is a gamble, now we ask which of these is what riskier? What they want to say is which of these has the high probability of you losing, right? And we say gambling or betting is riskier than buying treasury bill, right? That doesn't mean treasury bill, there's no way you will not lose the money. There is always a possibility. And a typical example is what happened to government bond in Ghana, where there was a default of payment, right? Okay, so there's always a possibility of risk, but the degree that has high degree of risk, that has high probability of the risk occurring, others have low probability of the occurrence of risk. So we want to use this example using age and death. So from here we can see that we are using age here. We are saying that for example, the probability of death of age 60 is approximately 1%. So when you are 60 years, the probability you die is 1%. Then when you get to 83, the probability that you die is 10%. Then when you get to 96, the probability that you die is 30%. So now looking at this, we say that the one who is 96 years old has high degree of dying. Have high degree of dying. The rate of this person who is 96 dying is higher than the rate of someone who is 60 years dying. Okay, so 30% is the degree of risk, and that is higher than 1%. Okay, all right. Now, I want to know how risk is different from peril and hazard, because sometimes we tend to use them interchangeably, as we tend to use them as though they are synonyms, right? But as we want to understand risk, it's better we differentiate it from certain terms that we have been using wrongly. Now, let's use peril. What is peril? Peril is a cause of loss. It's what? A cause of loss. Peril is a cause of loss. Peril is a cause of loss. So we are looking at what is causing a risk. what is causing the risk, right? What is causing the risk? We say risk is what? The possibility of deviating from what? The expected outcome or the desired outcome, right? So what is causing the possibility of you losing what? That thing. Okay. Now, so let's say, example, I bought a phone, right? And I live in a community that is full of that is full of criminals, thieves, right? Now, me living in that community, the community I live at this point, it has become a peril because it is the cause of me what? The possibility of me losing my what? My phone. Now, another example I'll give here is fire, right? Fire, fire. If fire can be a peril, right? Because if you have a house and the house catch fire, the cause of the cause is what? The possibility is the fire. Okay, the fire. All right. So another example is windstorm. Some can blow and can take off someone's roof, right? The roof is off, right? So the cause of that loss is what? The windstorm. Okay. All right. Now let's look at hazard. Hazard is a condition that creates or increases the chance of losses arising from a given peril, right? So, what is a peril, right? I'm not taking care of your gas, right? The gas you use, if you don't take care of the cylinder well, now it increases the chance of your burden being exposed to what? Fire outbreak, right? All right. Okay, so that is a typical example. All right, so that is hazard. Now I want to come to classification of what? Hazard. I'll give you another example here, right? A sickness can cause what? Economic loss, because when you are sick, okay, when you are sick, you definitely have to be spending, right? So sickness is a peril, but sickness can also be a hazard because it increases the chance of the person what? Dying premature. Okay. All right. So now let's go to the hazard. The sorry. Okay, so physical hazard consists of physical that increase the chance of loss. Physical property that increase the chance of loss. So put it on flight to me. Okay, so physical hazard. The physical property that increases the chance of loss from various peril. Now let's peril of a fire. Let's see the type of construction that was made. The way they did the wiring can be a factor. Where you are located, right, can be a factor. Like I said that someone was staying closer to a gas station and the gas exploded. I think it was a filling station. The gas was there. The place exploded and it affected this building. So this one is due to what? Physical location where the building is located. Okay. The person who is occupying a building can also be a physical hazard. How is the person taking care of the person? The person puts all plugs up when he's going to work. That the person make sure you have turned off the gas when he's an example of physical hazard. Now let's go to moral hazard. We are looking at morality here, right? Now there are instances where people take insurance, they take up an insurance policy for either their car, their burden, or something, right? And these people, at the end of the day, will find a dishonest way of causing the thing to happen so that the insurance company, the insurer will what? Replace it for them. Right? Okay. So that one is a dishonest way of what? Causing what? Hazard, or increasing the chance of what? Hazard. Okay. So you know that probably you have paid some money, they are supposed to refund you this amount when something gets lost, and maybe you feel you have paid for a long time, so you probably need to find a way to get it, right? Like those who take like a debt policy or something, and sometimes their mother, they use their mother, but their mother will not die. They go and take someone, it's their mother, just to what? Collect the money, right? Okay. So you know that you have insured your television, right? And if they see, they replace it for you. Now you know the replacing probably is going to be a new one, a new television. If you use the television for some time, it is not getting lost. So you find a way and you open your door. Then opening your door increase the chance of them stealing your television. So you leave your door open, and when the person comes and sees it, by the insurance company or the insurer will what? Replace the television for you. That's what a dishonest way of what? Increasing the chance of what? A loss. Okay. Then we have moral. Moral hazard. That one too increases the chance of what? Loss. However, that might not necessarily be a dishonest way. Dishonest way, the person has purported in his heart or in his mind that he wants to do something so that the loss will happen. Do you get me? But this one, sometimes when people take up insurance policy for something, they now relax. They relax as in terms of their character, what they have to do to make sure that this law does not occur. They lose guard. They don't put up that character that will prevent the loss from what happened, or the loss from happening. Okay. So for instance, if you have insured your money at the bank, so when I lose the money, the bank will have to refund it, and the insurance company has to refund the money to you. Then it is your duty to make sure that your PIN, certain information does not go out there, right? So that can make access to the bank, your bank account, it shouldn't go out there. If the person now, because he has insured, fail to make sure or put up the character or the attitude that will prevent the loss, then that is called what? Moral hazard. Okay. Okay. So that is it. So they can ask you what the difference between moral hazard and moral hazard. Okay. Moral and moral hazard. Okay. Legal hazard. Legal hazard. We are talking of the possibility of increasing the chance of loss, which is based on what? Legal requirements. Possibility of losing what? Of increasing a loss, which is based on legal what? Legal what? Requirements. Okay. So there are some laws that have been passed that sometimes increases the chance of what? A loss. Okay. So example that is given here is a legal doctrine that favor plaintiff. Okay, so example here is existent in the case of property exposure, right? In a jurisdiction where building code require new building conformity. So there are some places they'll say this area, we want this particular kind of structure, which if they are making this, then that particular structure will be unique, will be a modern one, and therefore will be very expensive. So if, for instance, out of your building is already there, not up to that standard, but it's there, they can come and collapse it. But something happened and you lose the building, and you are to build it, then you require that you build to meet the conformity of what? The required what? House design or house structure they wanted. So there are some legal requirements that increases what? the chance of loss. Okay. All right. Now let's go to classification of what? Risk. Let's go to classification of risk. Risk can be classified into various forms. The first one we have is what? Dynamic and static risk. Dynamic and static risk. Now, when we talk of dynamic risk, we are talking of risk that occur due to changes in what? An economy. There are risks that occur due to changes in what? Economy. So change in price, right? Example is what? Changes in price. Price. So if you budgeted, probably you are going to buy food stuff, and you have been, and it has happened to us, you know, that is happening, right? So we have, because 2020 was not good for Ghana at all. Our economy was very poor. In spite of things were increasing anyhow. So to the extent, it's very bad. So to the extent that when if you use 1,000 cedi to feed, you probably be using 1,500, 2,000 Ghana cedi to feed. Oh well. So because price of goods are and it's affecting everything. Oh. It's affecting the sale of everything, right from. So if prices of goods increases, now what is happening is you are going to use the additional amount you have to add to it to buy them. Then customers will, consumers will take, right? Then income and output and technology, right? If there's improvement in technology, sometimes the old one is not in it, right? For now, there are some people who lost income because those times they were using the typewriter and now computer desk service. You get me? So people lose income due to what? Changes that occur in what? A community. And it might be a good change though, but it might bring a lot to some people in the community. Now, static risk. Static risk, on the other hand, will occur if it would have occurred even if there was no change in what? The economy. And this one doesn't affect everyone in the economy or group of people in the economy. Normally it affects some individuals, right? Now, what they are saying that the possibility of you losing your car being stolen is not due to changes in the economy, right? Okay. Or fire outbreak. It's not changes in the economy. All right. So that's the difference between what? Dynamic risk and static risk. We have fundamental and particular risk. When we talk of fundamental risk, it involves losing what? Losing something that is impersonal in origin or circumstance. What are we saying here? We are saying that this particular risk and this particular thing you lost is as a result of something that affected the whole community, the whole society. It affects a large group of people. So when there's flood, look at the number of people who lose things, who lose their valuables. When there's earthquake, look at the number of people who lose. So it's not one person, right? And if we have poor leaders, and we are all losing, right? That is being raised because of poor management. Our exchange rate is our money is depreciating or the value every day. That's a lot of it affects a group of people. All right. Then we have particular risk. When we talk of particular risk, we are talking of risk that affects what? Particular person. It doesn't affect a group of people, right? So example is what? Losing a house or losing a car. The possibility of losing a house or losing a car is individual. It doesn't affect the entire group of the group in a community, okay, or in an economy, okay. We have pure and speculative risk. Now let me start with speculative risk. Speculative risk is where there's a chance of loss. When there's a chance of what? Possible loss or possible gain. And an example of this is gambling, right? Gambling. When you go and gamble, there's a chance of you losing or winning, right? This is what we call speculative risk. Normally, the person himself, the person put him or herself in that situation. Because of that, insurance don't normally cover that type of what risk. Okay, so if you go and play, go and bet, right? No, you want to put yourself in that sense. You can't go and now go and any insurance company to ensure that you don't lose. You put yourself in that condition. So it's either you win or you lose. Then we have pure risk. That is the risk that insurance company would insure. When we talk of pure risk, we are talking of the possibility of loss or no loss. The possibility of loss or no loss. We are talking of the possibility of loss or no loss. So if you own a car, you only have the possibility of you losing the car or not losing it. Okay, the possibility of you losing a car or not losing it. Now, if you have a burden, you have the possibility of losing it or not losing it. If you have an investment, you have the possibility of you losing it or not losing it. That is what we call pure risk. And that's the risk that is insured by what? The insurance company. Now, I want to further classify pure risk, right? Pure risk. Okay, the first one is what? Personal risk. The first one is what? Personal risk. And when we talk of personal risk, it's the possibility of you losing income or assets. It's the possibility of you losing income or asset. That is, it's a possibility of there's a possibility of reducing your ability to earn income, right? And when you talk of personal risk, the peril that are associated with is either premature death, right? As in business peril is what causes risk, right? Premature death can let you lose income. Dependent old age can let you lose income, but they are dependent, you are going to spend on them, you are going to take over. Sickness will incapacitate you from what? Doing certain work. There are people who are disabled. If they were having hands, they were having legs, they would have been working, but today now they are begging. If they could see, they would have been working, but they are begging now on the street because they are unable to what? Earn income. Then unemployment, right? If you are not employed, that's the peril of a personal risk. If you are unemployed, how do you make income? Because we make income when we get employed, right? Okay, you can get a gift though. So now property risk. Now, if you own a car, if you own a building, if you own a business, right? This risk is talking about the possibility of you losing that thing, that building. You might not lose all, but you might lose part of it, right? Possibility of you losing your car, the possibility of you losing your burden, the possibility of you losing your business. Okay. And we have two effects from this. We have direct loss and indirect loss. When you talk of direct loss, you have lost what? A burden. The burden, you could value it. It's what? Or you have lost a car. If you have sold the car, you would have earned an income. So there will be a worth on the car. So you've lost that thing, right? Now, the another thing is that now if you lose a car, now you have to, if you lose your car, now the inconvenience of you standing in a scorching sun to look for a car is there. That's a loss. That's what the indirect effect. And the extra income you have to spend on what? TNT every day is also what? A loss. It's the indirect loss. So direct loss is using the value of the car. And indirect loss is the additional expense that comes, or the additional expense or inconvenience that comes with you losing that particular thing. Then we have liability risk. Liability risk. Now, when intention or unintentional, you damage someone's thing, you know liability. Liability is you owing, right? So if you damage someone's thing, if you damage someone's car, if you damage someone's phone, if you damage someone's book, you would have to pay back. So it's a liability to you, right? So the possibility of you spoiling someone, and this thing, it happens. Maybe you are going and just unintentionally throw your hand, it hits someone, a hawker somewhere is carrying eggs, and it falls down, it breaks. The hawker expects you to what? Pay. So you will pay. Okay, so that's what we call what? Liability risk. Okay, then we have risk arising from failure of others. Risk arising from what? Failure of others. Risk arising from failure of what? Others. All right. So if someone promised or agreed to do something for you, so come and paint my house for me. This is the time. You give me the time. Don't come. You get me? I've lost something. I've lost valuable time, right? So this arises from when someone agrees something and the person, but it depends on the person. And whether it is loss of time, loss of money. Because sometimes when that happens, you go for another person, especially when the person take your money and go, that's coming, you pay another person to do it. Do you get me? So that's the way. So um that is it. So in essence, we are saying that risk is inevitable. It's likely to happen, and it's all around us. Hence, we have to manage our risk, right? Individually. If you have a car, you can put a tracker in, you can put alarm in to prevent it from stealing it, right? If you have a building, you can put what is it? Camera there, what you call those who can the thief. And you can make sure always whenever you step out, you check that all your plugs are off. It's a form of managing your risk, right? If you want to invest, you have to do economic assessment of that particular asset you want to invest in. Then decide that you're going for this because the loss is what. Okay. Thank you. So, in essence, what did we learn? I just want to go through it very fast, then we end it. So we learned about risk, and when we talk of it, we should go into it indeterminacy, and there should be a possibility of what? Loss. We talk of risks, that our external factors on where we stay, our environment, which influences the possibility of what? The loss that will happen. We said that risk normally comes with uncertainty. You cannot be certain and you say it's risk. If it's you are certain there's loss, then there's no risk, right? We also talk of degree of what risk. When we talk of we said what? It's whether it's high, probability of loss is high or low. That's the degree of risk. Then what did we talk? We talk of how to differentiate from risk from peril and hazard. And we say peril is what causes risk. Then hazard is what increases the possibility of what the peril causing what a risk, or what increases what the peril. We talk of we having physical hazard as in physical property or physical property that increases the chance of a loss. Then moral hazard, because some people find their own way, dishonest way to what cause increase the chance of a loss. Probably because they have something to gain from it. Moral is when you your guard from protecting and you behave differently as you don't care because probably if you insured the particular loss that will happen. The legal hazard, we are saying that there's a legal requirement that increases what the chance of loss. So if there's a law that this way they should put this time of maybe if you don't take care of your house that is old type, they put it off and then and there are instances where they have to do roads, like construct a road, and they have to break down people's buildings because of that, right? So that is one of probably the legal hazard. And we have various forms of classifications of risk. We said we have static and dynamic, where dynamic is what resulting from changes in what economy interface on, and static is individualistic. We have fundamental, where fundamental is impersonal, as it affects for people, and then particular risk is to a particular person. Then we have pure and speculative. Speculative risk is what is the possibility of gain and what and loss, but pure risk is loss or no loss. Okay. Then we have and the pair we have personal risk. We're talking of inability to earn income, property risk, you losing your property, the liability use that is calling someone's property, which is a lawsuit because you have to at the end of the day refund it and raise arising for favor of people who are going to do something for you. Then we concluded that consent risk is everywhere, it's inevitable. It's better we do what? We manage our risk. All right.